Hello and welcome to our Q3 2023 webcast. I am David Clément, and for those who don't know me, I am the Financial Instruments Topic Team Deputy Leader. So this summer, I succeeded to Scott Bandura, who was a regular contributor to such webcasts. So circumstantially, I am also a partner in the Canadian firm, but I am based in Montreal in Eastern Canada. So we have an exciting agenda for today's webcast. So we'll be discussing the three following topics, where the IASB, the ISSB, and the European Commission have been active recently. So I will start with the subject of lack of exchangeability in the context of IS21. Then my colleague Braian Paoli will cover the new IASB requirement on supplier finance arrangements. And Andreas will give you a sustainability reporting update. So we hope you enjoy the webcast and find it useful. So lack of exchangeability. So what was the issue? So IS21, which is the currency standard, so sets out the exchange rate that an entity uses at a micro level when it reports foreign currency transactions in the functional currency, or at a macro level when it translates the results of a foreign operation in a different currency, or the entity's entire financial statements in the presentation currency. So until now, IS21 set out the exchange rate to use when exchangeability between two currencies is temporarily lacking, but not what to do when the lack of exchangeability is not temporary, so it drags on, which has led to diversity in practice. So in this situation, some of the primary questions include, so what rate to use when translating foreign monetary items like foreign payables and receivables, cash balances, and what rate to use when translating the results of a foreign subsidiary or the entire group, for that matter, into the presentation currency, and what to do when there are multiple alternative rates that the entity can use to obtain the foreign currency. So although circumstances in which a currency is not exchangeable into another currency might arise, hopefully relatively infrequently, when these circumstances arise, economic conditions can deteriorate rapidly, and this can have a dramatic effect on your own, on the financial reporting, considerations. So in those circumstances, so the diverse views on the application of IS21 requirements can lead to material differences in affected entities' financial statements. So what happened? So in August 2023, the ISB amended IS21 to add requirements to help entities determine two things. So whether a currency is exchangeable into another currency, i.e. to make like a binary judgment, and then if this is so, then the spot rate to use when it is not exchangeable, i.e. to go through an estimation process. So these new requirements will apply from 2025 with early application permitted. So although this is only mandatorily effective in 2025, we thought it was relevant to tell folks about it, because early application is permitted, and we do expect that many impacted entities will want to apply the requirements early to help articulate and communicate the methodology used to address the currency challenges they face in part of their operation. So besides the aim to reduce the diversity in practice, so the ISB's objective for this project was also to improve the usefulness of information provided to investors by requiring entities to apply a consistent methodology. Then the amendments nevertheless allow for flexibility in the estimation approach, allowing for entities to weigh cost and benefit of different methods when they need to estimate a spot rate. So I'll elaborate more on this shortly. So yeah, the ISB provided essentially an only two-step approach. So the amendments to IS21 address all situations in which exchangeability between the two currencies is lacking. So, and we will get into that concept. So these new requirements specify that entities apply the so-called two-step approach. So the first step is the judgment to determine whether a currency is exchangeable into another currency. So if the entity determines that the two currencies are not exchangeable, then step 2 requires the entity to estimate the spot exchange rate. So what is this? How does this step 1 work? So how do we make this judgment? So determine whether a currency is exchangeable into another currency. So the amendments focus on the entity's ability to obtain the other currency for a specified purpose. So ability and a specified purpose. So when making this determination, the entity may only consider market or exchange mechanisms that result in enforceable rights and obligations. So let's call that legal markets. So in other words, only official rates should generally be considered in step 1. Well, the purpose for which the entity obtains the currency is important because in some circumstances, a currency may be obtainable for one purpose, but not another. So for example, in some cases, when exchangeability is lacking, the central bank might allow entities to obtain forex for critical goods or services such as fuel, food, or medical supplies, but restrict access to forex for dividend purposes. So the amendments lay out the assumed purpose depending on how the entity reports its foreign operations. So when an entity reports its foreign currency transactions in its functional currency, so the assumed purpose is to realize or settle individual foreign currency transactions, i.e. at the micro level. So whereas if the entity uses a presentation currency that is not its functional currency, so the assumed purpose is to realize or settle its net assets or liabilities, i.e. at the macro level, similar to translating the results of a foreign subsidiary, where the assumed purpose is to realize also or settle the net investments in the foreign operation. So to illustrate the concept, let's assume that a parent has an investment in a subsidiary. So in that subsidiary's jurisdiction, so the entities can obtain the parent's functional currency in exchange for local currency for importing critical supplies. So when translating the results of the subsidiary, then the parent would assess whether it is able to obtain its functional currency in exchange for the local currency for the purpose of realizing its net investment in its foreign subsidiary. So because the parent is prohibited from obtaining its functional currency for that purpose, then it would conclude that the local currency is not exchangeable into its functional currency for purposes of the group accounts. So it's important to note that that an entity's intention does not impact the determination of exchangeability. So as mentioned, instead, the amendments are focused on the ability to obtain the other currency, regardless of whether the entity actually does or intends to do so. So for example, an entity might have the ability to obtain another currency for the purpose of realizing its net investment in the foreign operation, even if it has no intention to actually do so. So whilst the entity might not intend on exchanging the currencies, the fact that the entity has the ability to obtain the other currency is the only relevant factor. So an entity also does not need to be able to obtain the other currency instantaneously. So the amendments allow for a so-called normal administrative delay in obtaining the other currency. So this concept was intentionally not defined by the ASB and will form part and parcel of the lack of exchangeability judgment based on individual facts and circumstances. So finally, in order to be considered exchangeable, the entity must be able to obtain more than an insignificant amount of the other currency for the specified purpose. So whilst an entity might not be able to obtain the full amount of the other currency that it would require, as long as it can obtain more than an insignificant amount, the currencies will be considered exchangeable. So the entity should be aware that this analysis is performed on an aggregate basis for each specified purpose. So for example, an entity has liabilities denominated in a foreign currency. So the entity then assesses whether the total amount of forex it can obtain for purpose of settling those liabilities is more than an insignificant amount compared with the aggregated amount, or the sum of its liability balances denominated in the foreign currency. So given the requirement imposed by the amendments, it is worth highlighting that the ISB expects the exchangeability between two currencies to be lacking only in narrow circumstances. Okay, so now that we've concluded, if and when you do conclude that indeed one of the currencies in your ecosystem is not exchangeable, then we go to step 2. So if you determine that an entity is not, if you determine that a currency is not exchangeable into another currency, then you must estimate the spot rate at the measurement date. So in developing these amendments, the ISB decided not to set a hierarchy of observable exchange rates to use. So whilst a hierarchy, like we have for fair value measurements in IFRS 13, generally has a benefit of increasing consistency, in this case, the ISB made the judgment that it might have imposed additional costs without providing more useful information. So the combination of a clear objective for the estimation and a choice of what approach to take to make the estimation allows entities to allow on a cost-effective approach considering their specific circumstances and the scale of the amounts at stake. So this means that an entity does not necessarily have to use a complex technique to estimate the spot rate. So for example, if there is a temporary lack of exchangeability between two currencies, using the first subsequent exchange rate after exchangeability has been restored may be a reasonable method for estimating the spot rate at the measurement date, depending, as usual, on the individual facts and circumstances. However, if there is significant volatility in the rate or a substantial time gap, an entity may determine that another estimation technique is required. So here we can also highlight that the board provided guidance on how parallel or black market rates might impact the step 2 estimation process. So an entity using an estimation technique might use any observable exchange rate, including rates from exchange transactions and markets or exchange mechanisms that do not create enforceable rights and obligation. That's where black markets come in, and adjust that rate as necessary to meet the objective in paragraph 19A of the standard. So the key point to remember is that whatever method the entity uses to estimate the spot rate, it must meet the objective specified in the amendments, which we've illustrated on this slide. So just to finish, with respect to disclosure, so as I mentioned earlier, one of the ISB's primary objectives of this project was to improve the usefulness of information provided to financial statement users where currency exchangeability is lacking. So accordingly, the objective in the standard is for an entity to disclose information that enables users of its financial statements to understand how the currency not being exchangeable into another currency affects or is expected to affect the entity's financial performance, financial position, and cash flows. So in this slide, we have listed some of the primary disclosure requirements, but this is not exhaustive. So as is the case with every disclosures, materiality will come into play in order for the entity to communicate information about this topic that is commensurate with the scale of the affected transactions and business units and the complexity of the facts and circumstances at hand. So on this note, I will pass it on to Braian to continue with the topic of supplier finance.
It would not be a complete webcast if we do not make reference to supplier finance, one of the hot topics of the year. This time, we want to bring some good news for the users of PwC guidance. During this quarter, we released an in-depth on supplier finance arrangements, which brings together all the requirements and related guidance for entities that uses supplier finance arrangements in one easy-to-read place. As you may remember, in May 2023, the IASB issued amendments to IAS 7 and IFRS 7 to include new disclosure requirements for these arrangements effective in 2024. Our publication, of course, lists these new disclosure requirements and gives guidance on them. In addition, although there are no further developments, we included in this document all the related guidance on other focus areas when entities engage in supplier finance arrangements. You can see in the slide the list of topics and questions that we deal with in our in-depth. We hope you find this publication helpful if you need to consider supplier finance arrangements.
So today we're going to talk about an update on sustainability reporting, and we'll focus on what we call the big three. So the international standards, the EU standards, as well as what's going on with the SEC in the US. And the reason we focus on those three is they are likely to apply to many of our large companies globally, and some companies will have to comply with more than one of these. So we're going to give you an update on what's been happening with the so-called big three. So beginning with the ISSB, the international standards, back in June, the first two standards, S1 and S2, were issued. So S2 being the climate-related thematic standard, and S1 being the standard that addresses all sustainability matters other than climate, as well as it has some of the general parameters for international sustainability reporting. So think about that as sort of some of the content that would be in IAS 1 or IAS 8 is found in S1. In addition, these standards are going to be effective January of 24, although there is a provision that companies can defer the effective date of the non-climate elements of S1 until the following year, i.e. just applying S2 and the general provisions of S1 in the first year. In terms of where this is going to be applicable, it's really dependent upon individual jurisdictions mandating ISSB reporting. As of yet, no one has done that, although there's various jurisdictions that are in various stages of either requiring that or contemplating whether that's the direction they want to go, as opposed to writing their own in-territory standards. So the idea here is that these are primarily disclosure-based standards, so they're fairly principles-based. There is some specific metric content where there are certain areas like greenhouse gas emissions where there are specific requirements, but generally it's a principles-based approach to identify what are the material risks and opportunities related to sustainability matters. And maybe one of the more important things as it relates to scope is that it focuses not on just what is material today, and the definition of materiality is the same as in IFRS, so it's a financial materiality perspective, but it's not just on what's material today, it's what's material in the short, medium, and long term. So even if something's not financially material to a company right now, if there's a reasonable possibility it'll become financially material in the future, that's still going to be within the scope. So that's sort of different maybe than the way the financial statements work. The idea here with the ISSB standards is they're supposed to be a global baseline that territories can then adopt, and should they choose to say, hey, we would like some additional disclosure on a particular thematic topic, that they can always mandate that over and above what is required by ISSB. So ISSB would be a baseline, and then individual territories have the option, if they would like, to add additional disclosure requirements on top of that. So moving on to the EU. So the EU's been working on their standards under something called CSRD, so the Sustainability Reporting Directive, which is part of the broader Green Deal initiative in Europe, which, despite its name, is broader than just climate. It addresses other sustainability topics as well. So CSRD was finalized earlier this year, and part of what CSRD mandates is reporting on sustainability. And those reporting requirements are in something called ESRS, so the European Reporting Standards. And those were issued back at the end of July of this year. Now, they're still subject to some approval process in the EU that will run until the end of September, and there's a possibility for that to get extended by 2 more months. But that approval process is a yes/no vote, which means that if the EU were to not move forward with those standards, they would have to go back and redo them, and that's not viewed as likely at this point. So it is highly likely that by the end of the year that the ESRSs, as are currently publicly available, that those will be the standards that need to be adopted. Now, the effective date of CSRD is such that certain companies are already in scope starting 1/1/24, so in just a few months. So we hope the ESRSs are finalized soon. That's a fairly small group of larger publicly traded companies. And then additional companies will come in scope with each following year, depending upon the scoping of CSRD is very complicated, so we're not going to get into all the details here, but depending upon which provision scopes you in will dictate when ESRS reporting is mandatory. But it's expected to scope in as many as 50,000 companies. And again, this applies to companies with operations in Europe, not necessarily headquartered or shares listed in Europe. So it's kind of consistent with this theme of a lot of sustainability reporting requirements around the world are not so much targeted at where a company is headquartered, but rather where it does business. So just a few maybe highlights on how ESRS is different than the international standard. So I mentioned earlier the international standard is focused on financial materiality. The EU standards, or ESRS, has a double materiality concept. So that means it covers financial materiality as well as impact materiality. So financial materiality sort of being what is the effect of sustainability matters on the company's operations, and impact materiality being, well, what effect do the company's operations have on the environment, society at large, et cetera. So that's what we call double materiality. Now, while those are clearly different concepts, if you think about how financial materiality is defined by ISSB, that it considers things that might be financially material in the future, that might be something that's captured by double materiality under ESRS today. So something that the company's having an impact on the environment, that may not be financially material to the company today, but it's quite possible that if that impact on the environment is significant, that somewhere down the road, some regulation or laws or other means will cause that situation to be financially material to the company, and therefore, even though it's an impact today, it might be financially material in the future, and therefore might still be in the scope of ISSB. So sometimes that distinction between financial materiality as defined in S1 and double materiality for some companies, that difference may not be as great as it appears on the surface. CSRD also has a mandatory assurance requirement. Now that starts with limited assurance for the first couple of years, and then the expectation is that it's going to move to reasonable assurance, so the same level of assurance as an audit opinion on financial statements at some point in the future. It's unclear exactly when that will happen. It's going to be a function of how quickly practice develops, I guess, high quality reporting at that point. There'll likely be a move towards reasonable assurance. So unlike the international standards, where we only have two right now, S1 and S2, with the idea that there'll be more thematic standards coming in the future, ESRS already has standards that cover all topics. So there's a few cross-cutting topics or standards, so maybe a little bit more similar to S1. And then there are topical standards on a number of areas, including climate, biodiversity, water, but also a number of human capital related and governance related topics. So they already have a full suite of standards from day one. And as I mentioned, this is already effective January 1 of 24. And unlike ISSB, where it's dependent upon jurisdictions implementing it, this is already going to be law in the EU. So, and again, it's phased in over time. So then turning to the SEC, so the US standards, which would apply to any SEC registrant. So again, that would include companies based outside the US that have securities listed in the US. The SEC did put out a proposed climate standard last year. We're still waiting for the final standard, hopefully coming sometime in the next couple of months, but that only addresses climate. But in the interim, they did issue earlier in September a final cyber security guidance, and that has some elements that would be captured by other sustainability reporting, as well as we're waiting on a new human capital disclosure rule, which again would pick up on some of the same topics that are in scope of S1 and in scope of ESRS. So we're still waiting on those. Maybe one other thing I would just add as it relates to the US, because again, it has sort of an extraterritorial element to it. The state of California is possibly going to enact some laws as soon as this month that would require scope 1, 2, and 3 reporting by companies over a certain size that do business in California, and do business is a very expansive definition. And in scope companies are companies that have revenue globally of over 1 billion. So just given the size of the California economy, many companies with greater than $1 billion in revenue do some business in California, maybe scoped into this. And that would be effective as currently drafted, I think, in 2025. So even if nothing happens at the US federal level, the largest state is moving forward on something that would scope in many, many companies. So that's what's happened to date. Now, maybe just turning to a few things that are on the kind of the go forward agenda. So the ISSB did issue an agenda consultation over the summer asking what they should focus on next now that S1 and S2 have come in. And I think what we said in our letter and what they heard from a lot of other constituents is certainly companies need help with implementation guidance. And the ISSB has already announced that they're going to do some work on implementation guidance, particularly around how to apply S2. And we expect that to come out as soon as later this year or very early next year. But there's also going to be an implementation group that's being set up that's going to help work through some implementation issues to help companies adopt ISSB. So that's certainly one area that was focused. Another area that was focused was what should the research projects be longer term. And so we had said that, and they heard this, I think, from a lot of other respondents, that biodiversity and human capital are the two that they should really focus on because they're very pervasive. Human capital is a relevant asset to every company, and it's a very important asset to virtually every company. So having some specific guidance in the ISSB standards on what are the key things to think about and report with respect to human capital is really viewed as critically important. Remember, the ISSB standards are very much linked to how does a company create value. And so if human capital is one of your most important assets, well, that means it's closely tied to how the company creates value. So having some specific guidance on that is important. And then biodiversity is just rapidly becoming the next issue behind climate in terms of global mobilization, that it's a crisis that needs to be addressed. And having some detailed guidance on that was deemed to be important by, I think, most people that responded to the letter. The last thing that we would just highlight is the way S1 is structured. The SASB standards are one of the things that are part of the algorithm as you figure out what beyond climate is in scope of your reporting. And we've certainly suggested to them, as have others, that taking another look at the SASB standards, a number of them were written several years ago, and reporting and sustainability in general have moved forward quite a bit in the interim. Like a good example, as we just talked about, human capital and biodiversity being two of the most important topics. Well, many of the SASB sector standards have very little content on either one of those, or when they talk about human capital, a lot of the human capital content deals with worker safety, which of course is one element of human capital, but there's many others that are often not addressed. And so we think the combination of these research projects plus maybe relooking at the SASB standards would be a productive use of their time. I already mentioned that one of the things they're going to be doing this fall is getting started on implementation guidance, both of the implementation group as well as with the with this illustrative guidance that they're going to work on related to the scope of S2. So those are the key developments with respect to the ISSB. As it relates to Europe, the individual member states have until next summer to write the elements of CSRD into their individual country laws. Now, what that means is they can decide to add additional requirements over and above what CSRD mandates. They can't reduce them, but they can add to them during that legislative process. And so the types of things that are being discussed are, what types of independence or professional education requirements, et cetera, should apply to the parties that are providing assurance as required by CSRD, for example. But they could also mandate additional disclosure requirements over and above what's in CSRD or ESRS. And most of those legislative processes are still in the early stages, so it's a bit difficult to say at this point exactly what will happen, but it's likely that different countries in Europe will have some additional requirements that are not quite the same. But the core reporting standards will be adopted in all countries as of the same date. The last thing I just wanted to highlight very quickly is, just given everything that's going on, we've published a lot of material in the last few months. So we did publish an in brief when the ISSB standards first came out. That, while it's called an in brief, is a fairly comprehensive document. Then we issued in July a much more detailed in-depth on S1 and S2, but they don't cover all the same topics, so I'd suggest you look at both. Then in August, we published a FAQ document, which actually covers all three of the frameworks, and it goes through a number of questions that we either have received or are anticipating receiving, because notwithstanding the fact that we have all these standards out there and they're very detailed, one of the interesting things about them is they don't address a lot of concepts that we know are going to come up in practice. And so if you think about the accounting standards cover many different types of transactions and issues that companies encounter. The existing sustainability standards, be they SASB, ISSB, ESRS, they tend to focus only on sustainability specifically, and they don't address, I'll call them broad concepts like, what does one do in sustainability reporting if one acquires a business or if you divest of a business? So when do you start to bring in the metrics of the target company, or when do you stop reporting the metrics of a company you divest? Should you follow the same the same process that you would follow for financial reporting, which we generally think is a good idea? But this document goes through things like that. How should you think about if I want to do segment reporting for my sustainability metrics? So it's kind of the broad topics that we're used to from financial reporting. Many of those are not addressed in the sustainability standards, and so this FAQ starts to try to give people some guidance on how to think about what we know are going to be questions that come up quite regularly. And all of this information is housed on our Viewpoint page. So with that, I know I've covered a lot of ground, but there's just a lot going on, and we'll update you again in the future. Thank you.
So that brings us to the end of our Q3 2023 webcast. So we hope that you found that useful and interesting. In addition to the recently released sustainability reporting publications that Andreas mentioned, you can find here a link to more information on the topic of supplier finance that Braian discussed. So as always, please feel free to reach out to your engagement team or your best friend at PwC if you need additional guidance on these topics or any other challenging topic you are facing. So thank you very much, and see you for the Q4 webcast in December. Thank you.